In this video, I am going to discuss about advanced variances. We discussed about basic variances in early videos, which are material variances, labor variances, variable overhead variances, fixed overhead variances, and sales variances. Now we are going to discuss about advanced variances. There are two types of advanced variances: planning and operational variances, sales mix and sales quantity variances. In this video, we are going to discuss about planning and operational variances. In the next video, we will discuss about sales mix and sales quantity variances. Planning and operational variances. Let's recap what is a variance analysis. Variance analysis is a technique used in managerial accounting to compare actual results with planned or expected results. These are also known as standard values. Let's consider a budgetary period. So this will be the start of the period and this will be the end of the budgetary period. So at the start of the period, companies prepare budgets. So these figures are known as standard values or budgeted values. At the end of the period, companies can obtain actual values or actual results. So what we did under basic variance analysis, we calculated the difference between the standard values and actual values. Now we are going to move one step further, which is advanced variances. So this is the start of the budgeted period and this is the end of the budgetary period. So this is the during the budgetary period. This does not mean that the during the budgetary period is the middle of the budgetary period. It can be anywhere during the start of the period and the end of the budgetary period. For simplicity, we consider here during the budgetary period. So at the beginning of the budgetary period, companies prepare budgets. These budgets include standard values. And at the end of the period, companies can obtain the actual values or actual results. And during the budgetary period, companies can revise the standard values. This is the main characteristic of planning and operational variances. Companies can revise the original standards during the period. So this will be the revised values. So now we can calculate the variances between the original standard and the revised standard, as well as the variances between revised values and the actual values. The variances between the original standard values and the revised values are known as the planning variances, whereas the variances between the revised values and the actual values are known as the operational variances. Remember that companies can revise standard values in order to prepare revised budgets. So when can the managers or the companies can revise the budgets? Changes in business conditions. If there are significant changes in the business environment, such as shifts in market demands, economic conditions, industry trends, or regulatory changes, companies may need to revise their budgets to adapt to new circumstances. Cost fluctuations. These are also known as market volatility around material prices. Raw material prices can be subject to volatility due to factors such as changes in supply and demand dynamics, geopolitical events, currency fluctuations, weather conditions, or global economic trends. When there are significant fluctuations in raw material prices, companies may need to revise their budgets to reflect the new cost projections. This is particularly important for industries that heavily rely on raw materials such as manufacturing, construction, or commodities. Changes in rate of labor. Labor rates can experience fluctuations due to various factors, such as changes in minimum wage laws, labor market conditions, collective bargaining agreements, or government regulations. If the cost of labor increases, companies may need to revise their budgets to accommodate higher wage expenses. This is particularly relevant for industries with a significant labor component, such as service industries. Internal changes. Internal factors within the company, such as changes in strategy, expansion plans, restructuring efforts, mergers or acquisitions, or changes in management, can necessitate budget revisions. These changes may require adjustments to revenue projections, cost structures, capital expenditure plans, or resource allocation. Unexpected events. Unforeseen events like natural disasters, supply chain disruptions, major accidents, or economic crises can have a significant impact on a company's operations and financials. In such cases, companies may need to revise their budgets to account for the effects of these events and reassess their financial expectations. So, these are the main factors that managers consider when it comes to revising budgets. Now, let's do this example. Company A produces product S. 1 kilogram of raw material Y is needed to produce 1 unit of S. This means 1 kilogram per unit. 1 kilogram of Y is $2 at the beginning of the budgeted period. This means $2 per kilogram. Budgeted output is 1300 units. Actual output is 1200 units. Actual raw material Y purchased 1200 kilograms for $2.2 per kilogram. Calculate the direct material price variance and direct material usage variance. Now let's draw this sketch. In order to insert the data they have given in this example. So this is the start of the period and this is the end of the period. At the start of the period, we have the standard values, whereas at the end of the period, we have the actual values. So the standard output or the budgeted output is 1300 units. So budgeted output 1300 units, whereas actual output is equal to 1200 units. Standard price of the raw material is equal to $2 per kilogram, whereas actual price of the raw material is equal to $2.2 per kilogram, and the standard usage per unit is equal to 1 kilogram per unit. Actual usage is equal to 1200 kilograms divided by 1200. This is equal to 1 kilogram per unit. Now we can calculate the variances. So direct material price variance is equal to standard price minus actual price multiplied by actual quantity purchased. So the standard price, which is this value, $2 per kilogram minus actual price, which is this value, $2.2 per kilogram. Actual quantity purchased, which is this value, 1200 kilograms. This is equal to minus $240, which means this is an adverse variance. This is because the actual price is higher than the standard price. Now let's calculate the direct material usage variance. which is equal to standard usage minus actual usage multiplied by standard price. So the standard usage is this value 1 kilogram per unit minus actual usage, which is this value 1 kilogram per unit multiplied by standard price, which is this value $2 per kilogram. Since this is 0, there is no variance. This is because the actual usage and the standard usage is the same. So there is no difference. This means there is no variance. This is how we calculate the basic variances. Now let's do this example. This is the same example as before, but this is bit advanced. Company A produces product S. 1 kilogram of raw material Y is needed to produce 1 unit of S. This means 1 kilogram per unit. This is the standard usage. And 1 kilogram of Y is $2. This means this is per kilogram. This is the standard price at the beginning of the budgeted period. Budgeted period is given here 1 year. Budgeted output is 1300 units. Now they are telling us 3 months into the budgeted period, the price of Y has increased to $2.2 per kilogram due to market conditions. Actual output is 1200 units. Actual raw material Y purchased was 1200 kilograms for $2.2 per kilogram. Calculate planning direct material price variance and operational direct material price variance. Now what we are going to do is we are going to calculate the advanced variances using these values. Let's draw this sketch again. This will help you understand this question easily. So this is the start of the budgeted period. This is the end of the budgeted period. And this is the 3 months into the budgeted period. So what we are going to do is we are going to revise the original standard with, so this will be the original standard. This will be the revised standard and this will be the results. So what are the values under original standard? The usage. Standard usage is equal to 1 kilogram per unit, which is this value here. And then we have the standard price, which is $2 per kilogram, which is this value. And then they have given us the budgeted output, which is 1300 units, which is this value. Now let's revise the original standard. This is because they are telling us that 3 months into the budgeted period, the price of Y has increased to $2.2 per kilogram due to market conditions. This means the new standard price of material Y is $2.2 per kilogram. Revised price $2.2 per kilogram because this has increased to 2.2 from $2 per kilogram. So what will happen to the usage? Is the usage is changing? No, it is not, because in this example they are not telling us that the usage is changing. So the standard usage will be the same. So standard usage 1 kilogram per unit. This is same as the original standard. So what about the budgeted output? Is it changing? It is not. It is the same. So the budgeted output will be the same. Budgeted output is 1300 units. It is important to note that there can be one or more factors changing at the same time. In this case, only the price is changing. There can be instances where more than one factor is changing or more than one factor is revising. So now what are the actual values? Actual usage is equal to 1200 kilograms divided by 1200 units. So this is equal to 1 kilogram per unit. This is the actual usage. So what will be the actual price? This value $2.2 per kilogram. And finally, what is the actual output? Actual output is 1200 units. Now using these values, we can calculate the planning and operational variances. Planning variances can be calculated using the original standard values and the revised standard values. These are the planning variances. Operational variances can be calculated by using the revised standards and the actual values. So these are the operational variances. Before we calculate the planning and operational variances for this example, let's go to the theory and then come back to the example and do the rest. Planning variances. A planning variance refers to the difference between the original standard and the latest revised standard. This is important. Latest revised standard. Latest mean this is the final revision of the budget because there can be more than one instances that a company revise their budgets. This is because companies can revise their budgets more than one time. So let's say this is the start of the budgetary period. This is the end of the budgetary period. During the budgetary period, companies can change their original standard more than one time. It can be 0, it can be 1, or it can be more than 1. So in this example, this is the latest revised standard. This is because this is the final revision that the company has done on their budget. These variances arise due to deviations from the original plan or budget. Planning variances occur due to uncontrollable factors. This is really important. Always remember that planning variances are uncontrollable. Therefore, operational managers cannot be held accountable for these variances. This is also important. Since the planning variances are uncontrollable, the relevant operational managers cannot be held accountable for these variances. So, this is the start of the budgetary period. This is the end of the budgetary period. This is the during the budgetary period. So this is the original standard, this is the revised standard, and this is the actual results. So the planning variances occur between original standard and the revised standard. Total planning variance is equal to original standard minus latest revised standard. In this case, this is the latest revised standard because there is only one revision. Let's say there is another revision here. So this will become the latest revision. So then the total planning variance will be the difference between the original standard and the latest revised standard. Latest revised standard is the closest to the actual results. See this example. Here we can obtain the actual results. The latest revised standard is the closest. In this case, this is the closest. Let's say there is no revision here. So the latest revised standard will be this because this is the closest to the actual results. There are two terms you need to know, ex ante and ex post. The original standards are also known as ex ante and the revised standards are also known as ex post. If there are more than one revised standards, total planning variance can be divided into sub-planning variances. So here this is the start of the budgetary period, this is the end of the budgetary period, and this is the revised standard 1 and then they have revised the standards again. This will be the second revised standard, which is also become the latest revised standard. This is because this is the closest to the actual results. Here we have the original standards. Here we have revised standard 1. This is revised standard 2. And here we have the actual values. And we can calculate the total planning variances between these two stages using original standard values and revised standard values too. And as you can see, there are two subsections, which is this and this. The total planning variance, which is here, is equal to the summation of these planning variances. Because at the end, both of the methods will calculate the variances between the same two durations. Now let's discuss about operational variances. An operational variance refers to the difference between the actual results and the latest revised standard. These variances arise due to inefficiencies and mismanagement of the operational managers and the staff of the company. Operational variances occur due to controllable factors within the organization. Therefore, operational managers can be held accountable for these variances. If you can remember, for planning variances, operational managers cannot be held accountable for these variances because these are uncontrollable. But operational variances are controllable. So the operational managers can be held accountable for these variances. So this is the start of the budgetary period. This is the end of the budgetary period. And this is the during budgetary period. So here we have the original standards. Here we have the revised standards. And here we have the actual values. So the operational variances can be calculated by taking the difference between the latest revised standards and the actual results. In this case, this is the latest revised standard because this is the closest to the actual results. So this will become the latest revised standard. So we have to calculate the operational variance by using these two values. Operational variance is equal to the latest revised standards minus actual results. Latest revised standard is the closest to the actual results. Even if there are more than one revised standards, there will only be one operational variance. Even if there are more than one revised standards, there will only be one operational variance. Let's consider this example. This is the start of the budgetary period. This is the revised standard 1 and then they have done another revision. So this will become the revised standard 2 and this is the end of the budgetary period. So we have original standards here, revised standards 1 here, revised standard 2 values here and actual values here. Even though there are two revisions, there will be only one operational variance, which is this. But when we consider the planning variance, this is the total planning variance, but there are two planning variances between these two sections. Which is why it is said here, even if there are more than one revised standards, there will only be one operational variance. As you can see, this is the only operational variance in this example. But there are two planning variances. And the total of these two planning variances is the total planning variance. Now let's go back to the example and complete the answer. So the planning variance will be these two values and the operational variance will be between these two values. So the planning variances. So now let's calculate the planning direct material price variance. So this is equal to standard price minus revised price. If you can remember, when we calculate the basic variance analysis for direct material price variance, we used actual price here. But in this case, we are going to use the revised price because this is the planning variances multiplied by the actual quantity purchased. So we have to take this value here in order to calculate the direct material price variance, because this 1200 kilograms is the actual quantity purchased. So this is equal to 2 minus 2.2. 2.2 is the revised value, 2 is the standard value, multiplied by the actual quantity purchased, which is 1200. This is equal to negative $240. So this is an adverse variance. Now let's calculate the planning direct material usage variance. So this is equal to standard usage minus revised usage multiplied by standard price. So the standard usage is equal to 1 kilogram per unit, which is this value, and the revised usage is this value, 1 kilogram per unit, multiplied by the standard price, which is $2 per kilogram. Since this is 0, the planning direct material usage variance is 0 because we did not revise the standard usage value. Now let's calculate the operational direct material price variance, which is equal to revised price minus actual price multiplied by actual quantity purchased. So the revised price is $2.2 per kilogram, which is this value, and the actual price is also $2.2 per kilogram multiplied by 1200 kilograms. Since this is 0, operational direct material price variance is 0 because the revised price and the actual price is the same. Now let's calculate the operational direct material usage variance. So this is equal to revised usage minus actual usage multiplied by revised price. So the revised usage is 1 kilogram per unit and the actual usage is also 1 kilogram per unit. So this will also become 0. This is how we can calculate the planning and operational variances. Another important thing to note that when we calculate the operational variance, we consider the latest revised standard as the original standard and just assign these values to these equations. These equations are the same as for basic variance analysis. So here it should be the standard price minus actual price multiplied by actual quantity purchased. The standard price has revised. That is why we use the revised price here. For the direct material usage variance, what is the equation? It is standard usage minus actual usage multiplied by standard price. Since the standard is revised, we use the revised usage and the revised price. So when it comes to calculating the operational variances, do not consider the original standards. Consider the latest revised standard. Now let's discuss about the advantages of advanced variances. Suitable for volatile market conditions. Advanced variance analysis is particularly beneficial in volatile market conditions. During periods of market uncertainty or rapid changes in business conditions, traditional budgeting or variance analysis may not adequately capture the dynamics of the market. Advanced variances provide a more detailed and nuanced understanding of performance deviations, allowing organizations to adapt quickly to changing circumstances. Enhanced accuracy. Advanced variances provide a more detailed and accurate analysis of the factors contributing to the differences between planned and actual results. By breaking down the variances into specific components such as price variances, quantity variances, efficiency variances, or mixed variances, managers gain deeper insights into the root cause of performance deviations. Improved decision making. Advanced variances enable better decision making by providing managers with a comprehensive understanding of the drivers behind the variations in performance. This knowledge allows them to identify areas that require attention or improvement, allocate resources effectively, and make informed decisions about cost control, process optimization, pricing strategies, or product mix adjustments. Performance evaluation. Advanced variances facilitate a more thorough evaluation of individual departments, products, or processes within an organization. By comparing the planned and actual performance at a granular level, managers can assess the effectiveness of different components of the business and identify areas of strength or weaknesses. This evaluation supports performance measurement, goal setting, and performance based incentives. Targeted corrective actions. The detailed analysis provided by advanced variances help in identifying specific actions needed to address performance deviations. Managers can pinpoint the areas where corrective actions are required, such as negotiating better supplier contracts, improving production processes, enhancing workforce training, or adjusting price strategies. This targeted approach improves the effectiveness of remedial actions and increases the likelihood of achieving desired results. Here are the disadvantages of advanced variances. Complexity. Advanced variances involve more complex calculations and analysis, which can be challenging and time consuming. The data requirements, formulas, and interpretation of results may require a higher level of expertise, training, and understanding of the underlying concepts. This complexity can limit the accessibility and usability of advanced variances for organizations with limited resources or less specialized accounting knowledge. Blame game mentality. The detailed breakdown of variances in advanced analysis can sometimes lead to a culture of blame within the organization. When variances are dissected into specific components and attributed to different departments or individuals, it can create a divisive environment where departments or employees start blaming each other for the deviations. This blame game mentality can be counterproductive to teamwork, collaboration, and the overall organizational culture. Increased information overload. The detailed breakdown of variances in advanced analysis can result in a larger amount of information, which may overwhelm managers or decision makers. It can be difficult to prioritize and focus on the key drivers of performance deviations among the numerous variances. Without proper attention and understanding, the additional information provided by advanced variances may not be effectively utilized or could lead to confusion. Subjectivity in assumptions. Advanced variance analysis often involves making assumptions and estimates to isolate specific components of variances. These assumptions can introduce subjectivity and bias into the analysis, potentially impacting the accuracy and reliability of the results. It is essential to exercise care in setting assumptions and ensuring they are reasonable and supported by relevant data. Cost considerations. The implementation of advanced variance analysis may require investments in information systems, software, or additional personnel within specialized skills. These costs should be carefully evaluated against the expected benefits and the organization's capacity to absorb the expenses. For small businesses with limited resources, the cost of implementing and maintaining advanced variance analysis systems may overweigh the advantages. Thank you for watching. See you in the next video.